Hi, welcome to our lecture. In this week, we will continue with our discussion on mergers and acquisitions. An important service of an investment bank is to provide recommendations on valuation over targets. This video will be focusing on valuation techniques in mergers and acquisitions. Frequently used valuation techniques include comparable company analysis, precedent transaction analysis, DCF analysis, LBO analysis, and recap analysis. In the third week of our lecture, we have learned comparable company analysis and DCF analysis in IPO pricing. Comparable company analysis and DCF analysis can also be applied to valuing a target firm in corporate takeovers. Let us first have a brief review of comparable company analysis. In a comparable company analysis, the first step is to select a list of comparable companies, which may include companies in the same industry and companies share similarity in size, products, customers, geography, profitability, and growth opportunities. After selecting the comparable companies, an analyst calculates several key financial multiples of comparable firms, such as P/E ratio and EV to EBITDA ratio. And the multiples are used as benchmarks to estimate the market value of a target. For example, the equity value of a target can be estimated by multiplying its projected net income by comparable P/E ratio. A comparable company analysis is a market-based analysis, in that the multiples are subject to the influence of market sentiment. In case of market exuberance, a buyer may risk overpaying for its target. Another limitation of comparable company analysis is that sometimes it is difficult to find good comparable companies. When comparable company analysis is applied to takeovers, we also need to be aware that this analysis is based on prices of comparable firms in the open market. But acquirers would usually be willing to pay a higher price than minority investors in order to gain control. Besides, an acquirer is willing to pay a higher price if an acquisition produces synergy, such as economies of scale and economies of scope. Thus, valuation based on comparable company analysis may produce a lower valuation because it does not include control premium and synergy. And we have also learned about the DCF analysis in week 3. A DCF analysis uses projections of future free cash flow to estimate the market value of a target. This analysis is not influenced by the current market condition, and valuation obtained with a DCF analysis is called intrinsic value. DCF serves as an important reference to check valuation implied by comparable company analysis. DCF is also feasible when it is hard to find comparable companies. But DCF also faces limitations because its accuracy is subject to assumptions about future cash flow, terminal value, and the discount rate WACC. And different assumptions may cause significant difference in the final valuation range. Besides comparable company analysis and DCF analysis, a third method is precedent transaction analysis. The techniques used to conduct a precedent transaction analysis are similar to a comparable company analysis. In precedent transaction analysis, an analyst needs to select a universe of comparable acquisitions, and the financial multiples paid by the precedent acquisitions will be used to derive the valuation of the target company. As a general rule, transactions happened in the last 2 to 3 years are the most relevant because market conditions can significantly change in longer term. Older transactions may be relevant reference if they have similarities in macroeconomic conditions and business cycle of the target. A big difference between comparable company analysis and precedent transaction analysis is that control premium and synergy are included in transactions analysis. Because this analysis is benchmarked to previous takeover transactions. So precedent transaction analysis is expected to generate a higher pricing range than comparable company analysis. One limitation of precedent transaction analysis is that it is based on historical transactions, so there is a time lag. For example, valuation based on transactions during 2007 to 2008 financial crisis may not generate solid pricing references for deals in 2010. In the market for corporate controls, aside from the participation of strategic buyers who seek to consolidate the business of a target and gain synergy from it, there is another type of buyer called financial buyers or financial sponsors. Financial buyers participate in leveraged buyouts, where they borrow a lot of money to acquire a target and expect to resell a target later with a profit. In the next week, we will have a more detailed discussion on leveraged buyouts. An example of a financial buyer is a private equity fund. Financial buyers would demand an acceptable required rate of return for the private equity investors, who would usually demand a return of larger than 20%. An LBO analysis is a valuation technique that determines a range of implied purchasing price for a given target based on a given range of acceptable returns. The projected returns can vary with different assumptions of purchasing price, leverage, and selling price. To do an LBO analysis, an analyst first assumes a range of entry multiples for the acquisition price. For example, if the entry EV to EBIT multiple ranges from 7 to 9, a target with EBITDA of $100 million will be worth within a range of $700 million to $900 million. Next, an analyst provides a range of capital structure of a target based on current market condition, i.e., how much debt and how much equity could be used to buy the entire business of a target. Say if the credit market supports leverage ranging from 60% to 70%, for a target valuing at $700 million, the amount of debt would range between $420 million to $490 million. And the amount of equity contribution would range between $280 million to $210 million. The amount of debt used can have huge impact on free cash flow in future operations of the target. If the financial investors expect to sell the target 5 years later, an analyst will, under different assumptions of capital structures, project the target's annual free cash flows, annual debt servicing, including both interest and principal payments, and any value of debt at year 5. To derive equity value of the target at exit, An analyst will also need to provide a range of exit multiples to estimate the firm value of the target at exit. Next, an analyst can use different combinations of entry multiple, capital structure, and exit multiple to calculate internal rate of return, or IRR, which is return to financial investors. The calculation results of IRR is sensitive to different assumptions of capital structure, entry multiples, and exit multiples. At last, an analyst will choose a reference range of entry prices that can meet the return expectations of investors. The LBO analysis is benchmarked to acceptable returns to financial sponsors. This analysis is also informative to strategic buyers because when they bid for a target, they also need to compete with other financial buyers on the market. LBO analysis would often produce a lower price range than other pricing techniques. A first reason is that financial buyers often cannot derive synergy from an acquisition. Another reason is that financial buyers require a high IRR to compensate for their risk takings in LBOs. Their demands in return result in lower purchasing prices. In our next week, we will have a separate chapter on leverage buyouts. A breakup analysis can be applied if a company's assets can be separately sold on the market. For example, a good candidate for breakup analysis is a REIT, because the assets of a REIT are largely comprised of physical real estate assets. In theory, the value of a company should equal the sum of its parts plus synergy. If the sum of independent assets is in excess of the company's value, there is an arbitrage opportunity. For example, in year 2007, Blackstone acquired Equity Office Properties Trust for $39 billion. Equity Office Properties was the largest office REIT in the US at that time. Within months after the acquisition, Blackstone started to sell many properties of the REIT in the private real estate market. And this deal is considered a classic arbitrage between the public and private real estate market. At the end of valuation analysis, an analyst will provide a valuation summary of price ranges indicated by different valuation methods. This summary is usually presented as a football field analysis. For example, this picture is an example of a football field analysis. This picture clearly shows the minimal and maximum range of price valuations. Because different valuation methods generate different valuation ranges, this analysis helps to finalize a valuation range by analyzing the overlap of the different methodologies. This analysis is so named because of its visual resemblance to a US football playfield. For a target company, a football field analysis would also include the current share price and 52-week high and low as references. Okay, in this video, we have discussed 5 valuation techniques that can be used to value a target company. Thanks for watching. In our next video, we will discuss anti-takeover strategies.